Now, while we're all out to make money, what do we do with our hard-earned cash? After we made all this money, what do we do with it?
Some say invest in mutual funds, others say property, while others choose to see their savings grow in a fixed deposit account.
Now, one of the fundamental basics when investing your money is knowing which return of investment is right for you. And each person's financial situation and willingness to take risks are different as well. Therefore, every person's ROI will be unique as well.
Yep, so to dissect this further and to help you make the right choices, we have with us Mr. Financial Freedom, Yap Ming Hui. Welcome back, Mr.
Welcome back. Good morning.
Good morning.
Good morning.
So we're talking about ROIs today.
Yeah.
Yes.
It's a term that's thrown around a lot when it comes to business deals, when it comes to investing.
Yes.
Break it down for us.
For an
what
individual.
actually is
Okay,
return
basically
investment?
ROI stands for return on investment.
Yeah.
Okay, so to put in layman term, ROI means that it's a gain that you actually make from the investment, but in the form of a percentage.
Right.
So it could be like your ROI is actually 5%, your ROI is actually 10% or 15%. So say in that case, like for example, if you put money in the fixed deposit,
Yep.
then your ROI could be after 1 year, it'll be about 3% plus or minus.
Okay.
Right.
So this is what I mean by ROI.
Okay, and how
Yes.
does one usually calculate this
So
ROI?
basically, to calculate ROI, if I take an example, so we invest we invest 100,000. So at the end of the 1 year, 100,000 may become 108,000.
Okay.
Okay. So if you take like then we have 108,000 minus 100,000, we make 8,000.
Okay.
So this 8,000 we divided by the
Initial 100,000,
100,000 we
right?
got,
Okay.
then our actually return would be 8%. Okay. So this is how we calculate the ROI. Okay.
So
Okay.
share with us, how can you make sure that your ROI is worthwhile?
Yes.
Because obviously when you're investing, there's some form of risk that you're taking,
Yes.
right?
Yeah.
So how do you make it worthwhile in terms of the risk, in terms of
The amount you initially invest?
and also the inflation, overcoming inflation.
I think there are three very important rules or rules of thumb that we need to be mindful
Right.
when we actually talking about making ROI working for us.
Okay.
Number one, we need to make sure that we understand the power of ROI. We must never underestimate even the small impact of a small ROI. Let me
For
give you an example.
example,
Like for example, we got 100,000.
Yeah.
Okay, if we invest for 20 years, okay, at 5%. At 5% ROI, at the end of 20 years, we will have 260,000. Okay, so if we actually invest at 8%, 8% instead, we will end up having 460,000.
Right.
So it's only 3% difference, but we end up having 200,000 extra.
Right. But this is in the course of obviously 20 years.
Of course, 20 years, but most people actually will actually invest the money for that long
Yeah.
time.
Okay.
Okay, so with a 3% difference, we can actually have a 200,000 difference here.
Yeah.
Number one. Number two is 75% more of money. So how do you like that? Just to increase 3% extra of ROI.
Oh, I
Okay?
think the more percentage, the better, I think, for everyone. But I
Yes.
think the key is also, with these sort of percentage, it's nice to throw numbers around, but
Yes.
the realities are what sort of, investment versus your
Yeah.
risk appetite. How do you
Yes.
go about that?
I think very importantly, number two, I think that's why I think
Yeah.
come to number two, is that we need to know what is the right ROI for us to actually expect. Okay?
Yeah.
Say number one, I think the minimum ROI that we must actually invest to actually target for is that it must be a return, at least it must be equal or more than inflation rate.
Of course.
Right.
Say for example, if the inflation rate actually is 3%,
Right.
okay, then we must actually invest higher than 3%,
Right.
or otherwise our actually capital will shrink
Yeah.
instead of actually growing.
Yeah.
Okay, that's number one.
Yeah.
So basically, the rule of thumb is that if we have got a holistic plan, I showed you last time
Yeah.
about roadmap, then we should derive from the suitable ROI for us, whether it's a 7%, 8%, or 9%. Okay, but if we don't have a roadmap or we don't have a holistic plan, okay, then what do we do? Then what we actually do is that the rule of thumb is that we actually target for at least 3 to 6% higher than inflation rate. So if inflation rate is actually 4%,
Yeah.
3% extra is like 7%.
Yeah.
So actually 6% extra than 3% is about 9%.
Yeah.
So we should target between about say 7% to about 10% kind of range
Right.
for rule of thumb. Yes.
Okay, but then again, which brings us back to our age-old question that we always ask you, Mr. Yap. Which investments do you take part in? How do you know what kind of safe mutual fund to invest in? Or do you put it in ASB, or do you put it in a safe deposit? Fixed deposit?
So that's why once we actually have a target, for example, we actually intend to achieve 8% target return, then we need to know, like what you say, what kind of investment can actually help us to get the 8% return? Okay. In fact, I want to share also, first, what are the investments that I will guarantee you won't get you 8% return, no matter how long you invest?
I'm taking notes.
Now, number
I don't
one,
know about you.
Okay, you should actually, if you invest in, like, for example, this fixed deposit, there's no way you will get 8%.
Okay.
You're likely to get 3
5 years or 10 years, So if you invest in the current account, no, even a saving account, money market funds, okay, life insurance. No, some people invest in life insurance. I can assure you, you will never get 8%. No matter invest for 20 years. Okay. And also, you will not for like Sukuk Malaysia. I think there's one government kind of investment that promise to give you Sukuk. They promise to give you 5%. Right, obviously. So you won't get 8%. Now, so now we go to the investment that can give you 8% return. So the investment that can chances give you 8% return over the long run, number one could be like bond investment that give you yield and also some kind of appreciation. It will be also like shares, stocks market. It will be like property investment. Okay. It will be also like ASB, Amanah Saham, Bumi Putra, and such kind of things. It will be able to give you something like 8 or 9% kind of return in the long run. So which means to say, when you want to invest with a certain target return that you got, then you need to know this one might as well avoid and then go for the one that actually can give you the kind of return that you want.
But we are also saying, you know, I mean, don't avoid these things. I mean, for example, life insurance is pretty much a must if you want to take care of your health and disability.
I guess what Mr. Yap is saying is don't go on the tangent of thinking that that is going to give you ROI. I mean, that's for protection. That's the cover.
You got it as a great right. The insurance actually is very much for protection purpose, to protect ourselves against death, to provide security to family, but never for something to target for 8%. I think that's why you asked a very interesting question to say that, of course, the more return to be even better. Now, I would say, if we are talking about managing our serious money, hard-earned money to grow to achieve financial goals, I would suggest that we never target investment returns more than 12%.
No, not more than 12%.
To me, based on my personal experience, professional experience, if you target more than 12%, you are not investing.
You're gambling,
speculating. Gambling. Okay.
There's a gamble factor in there. There's a risk.
What happens when you actually invest more than 12%? When you invest more than 12%, chances are not only you may not be, for example, you're targeting for say 20% return, which sounds very good and very exciting when you calculate on the paper. But the question is that instead of achieving 20%, chances are you may end up losing your money by 20% or even 30%.
So in your professional opinion, do you think for some people who has high risk appetite, they might have this amount of capital right there? So how much do you think they can apportion, or it's safe enough to say, okay, by keeping this portion, I can still steadily appreciate with an 8% investment ROI, but then there's a certain portion where I can go out and maybe aim for slightly more?
I would always suggest, I think Joanne may actually remember, I would suggest that we put our money in 3 buckets. One bucket is for the low risk asset, which mainly for our emergency cash. Okay. Then the second bucket I'm talking about just now, we talk about 8%. This is you're talking about the second bucket, targeting to invest for retirement and for our children education, our home purchase. Then if you got something extra, and I think extra or at most, I think we should limit our high risk, aggressive return kind of investment at most to 20%. 20%. So if you actually can limit it to 20%, then we know that at most
that's how much we're gonna burn.
If you burn everything that we have got there, at least it's only 20% what we got. No, instead of 100% of your whole portfolio.
But just very quickly, one question before we have to wrap this up, Mr. Yap. What about getting somebody else to manage your money for you?
Yes.
Ah.
Yeah. I think it's very important for us to actually, if you do not have time,
Yeah.
you do not have the expertise,
Yeah.
then it's important that you can actually find a professional to actually invest for you.
Like a financial expert like yourself.
Like for example, like investment fund manager,
Yeah.
like for example, some of the actually property managers.
Yeah.
But the idea is that we need to make sure that this person is properly licensed, number one.
And
Number
trustworthy.
trustworthy. I mean, at least look trustworthy.
Look trustworthy. Yeah? Okay.
Yes. Okay. But more importantly is that properly licensed.
Right.
You
Yeah,
know?
I think that's
and
key.
then we want to
Track
make sure
records.
that
I mean,
track record
yeah.
actually is very important. And very importantly is that we want to ask the question is that if we were to put the money there, if things were to go wrong.
Yeah.
Worst case scenario.
Worst case scenario. We always ask this question. You know, it's like devil's advocate.
Yeah.
Worst case scenario. How are we going to get the money back?
Yeah.
Yeah.
Yeah, that's very
He
important.
needs a plan. The person needs to have a plan.
Have an exit plan. You know,
Exit strategy.
so otherwise everything may get burned together with a particular so-called professional.
Professional.
Yeah.
Okay.
All right, that's very informative. Thank you, Mr. Yap, for coming on to the show. Obviously, we'll be speaking to Mr. Yap very soon again. And of course, he will be having his upcoming
Two-day workshop?
Yes.
workshop. What will
Yeah.
you be talking about?
I'll be actually talking about the 8 pillars of money management. The idea is that I think a lot of us, we spend a lot of time making money, but there's not enough effort talking about how do we manage our hard-earned money.
Okay.
So we hope that this workshop will be able to help those people who want to learn how to actually manage their money, how to actually optimize their hard-earned money better to come to the workshop so we can share more with that.
Okay.
Great.